Hello and welcome back to the ROI Channel, the Return on Investment podcast. And we have Ben Kelleran back on the show to discuss all things that are happening in terms of the offshore sector. He's discovered what I think is a gem, a diamond in the rough. So we're going to talk about that. Guys, anything we say is just a chat between two lads. Nothing is to be construed as investment advice. And with that, Ben, welcome back to the show. How are you, sir?
Yeah, thanks for having me on. Definitely looking forward to chatting on a couple interesting opportunities. So,
Yeah, well, we're going to dive straight into it. We're going to have a no fuss approach today. You brought to my attention an interesting, to say the least, opportunity in the offshore space. However, as often coincides, interesting opportunities often coincide with kind of an ugly situation. So I would love for you to talk to us about your thesis on Sable Offshore Company. Maybe give us a little bit of the backstory as to why it's so goddamn hated and what the opportunity is looking like for the future of this company.
yeah, so this one I came across, I think, this spring, and I definitely borrowed the idea a little bit from Judd Arnold, who had on my podcast recently. But I think it's one of the most interesting setups I've seen in anything energy related. But for some quick background on the company, basically, this asset that they own is called the Santa Ynez unit. I'm probably butchering the pronunciation, but they are sitting on a massive offshore resource in federal waters off the coast of California. And as soon as people hear California Oil Company, I'm sure that's an automatic red flag. But they are targeting like $1 per share per quarter in dividends. So hopefully that'll get people at least interested enough to kind of stick around. But I mean, the stock's at 23 something right now, but that's a pretty chunky payout once they start to ramp production. But anyway, the setup is the field itself was Exxon's best asset for decades in the US, and they had a spill in 2015 and it's been shut in since then. But now, since Sable has taken over the asset, it's been one of the most interesting things that I've seen in a long time. But they have the field itself and three platforms and processing facilities onshore. And the pop in the last month is due to settling with Santa Barbara County, which is, in my opinion, like the last green light before first production. Like there's other kind of regulatory stuff, but that's kind of background noise and will
Yeah,
happen
so
as they get into
explain
it. So
explain the dispute there. So this was a producing offshore project. We had a little bit of a spill, and then we had some angry Santa Barbarians making some noise, and things kind of got shut in for a while. This went on for how long exactly?
yeah, so it's been shut in since 2015, so basically a decade. And so the setup right now is they have a, I think it's 10% paid in kind loan to Exxon, which is I assume going to be refinanced. But basically, that'll happen once they get first production and get kind of tick some of the boxes on that. Um, but with the spill, I mean, they didn't have, was it like the shut off valves on some of the pipelines, and so that's not going to be a happy incident for a bunch of people in California, understandably. But the settlement recently, basically, they have a conditional settlement that as soon as they install, I think it's 16 valves on the pipeline, then the county is going to be dismissing their lawsuit, and that's what not saying held the stock back, but I mean there's no real revenue right now. It's no production. You're basically betting on what the asset's going to be worth once it starts producing. But it
So
had a
what's it
big
going to be
pop.
worth then? What's it going to be worth when this thing gets up and running and gushing black gold through its pipe?
I think $10 billion is a pretty reasonable. I think that could look like a lowball estimate in a couple of years.
Ooh, okay.
The was it current market cap plus debt is like a little over 2 billion and change. I could be,
Two and a
I'm in
half
the right
billion.
ball.
Two and
Yeah,
a half
in the right
billion.
ballpark. But the thing that makes this so interesting is basically it's all the things that's kind of the opposite of shale. So it's like low cost production where I think Exxon was producing at like $15 a barrel before the shut in. And I've heard a couple of people that are familiar with it say, like, yeah, management thinks they can get it down to $10 a barrel production cost. And that's after like ramping up production over the next 3, 4, 5 years. It's low decline rate. I think it's like 7 or 8% a year. And one of the other things that's interesting is the like oil field technology's come a long way in the last decade. And so I think the production ramp they're projecting is probably going to look conservative in a couple of years. But we'll have to wait and see on that. But basically, for 2025, they're kind of guiding to, what was it, 28,000 barrels of oil per day, and kind of ramping from there. So, like, if you look at how much money they're going to put in versus how much is coming out, it's has the potential to be a huge cash cow, lots of dividends, potentially lots of buybacks, but I have to wait and see on that. Um, but I think the biggest catalyst, like next 3 to 6 months, are going to be announcing first production, which I think is imminent from some of the commentary I've seen, and refinancing the Exxon debt, which I would guess is like late Q4, sometime into Q1. Like I would be surprised if we get to, I would say, March without a refinance, but we'll have to wait and see on that. The kind of big picture on like dividend payouts and all that is if they're targeting $1 per quarter per share, then I mean, put that at a 4% yield, right? You're looking at a $100 stock. So they think they can get the dividend up by late 2025. We'll have to wait and see on that, but
All right,
I
so
think it's one of those things.
let's talk. We can get to 20,000 barrels a day with, if oil's, I'm waking up here, oil's telling me it's at 68. So you've got a, quite a healthy margin between the lifting costs of this thing. How much do they have to put in to get to first production? And this is a low decline asset that you mentioned. So presumably from there on in, CapEx would be minimal to low. How much money is needed to get this thing up and about, and how are they going to structure that?
Yeah, so that's where the recent equity raise came in, where I think they kind of underpriced it, but that's I guess one of those things where they definitely took some risk out as far as the cash runway. So the equity raise was it 7.5 million shares at $20, and that was that giant like spike down sell off. Was it like a week ago, week and a half ago on Friday? And between that and the cash on the balance sheet and like the warrant exercises, which should be cleaned up, I would say sometime in November, based on some of the terms in the warrants. I would guess like first couple of weeks in November. I think they're sitting at like bit over like 350 million on cash. I'd have to do the rough estimates, but basically they think it takes 200 million to get it back into production. And first revenue is probably going to be late this quarter. So,
Okay, well, that seems quite reasonable given the margins that we mentioned on the lifting costs. And we've got how many years of production if we were to use a stay flat production of, let's say, 20 million barrels? You
I
said 20
mean,
million
we'll
barrels,
have
20
to,
million.
I think they're, I'll pull up the, let's see if I can share my screen here on the production ramp. But
Let me give
I think
you.
they're looking at like 28 to 30,000 barrels a day by, let's see, share screen. All right, there we go. Um, we're looking at kind of 28,000 is kind of projection for 2025 and ramping from there. They're probably looking at, I would guess, 100 to 200 million of capex kind of for the first several years as they try and ramp. I would assume this looks what, like by the time we get to 2025, 2026, I would guess that this looks pretty conservative as far as their production. We'll have to see if they start to spend, but it's not like shale where it's like, oh, you put in a bunch of money, get it all out in 6 months, and then you're on to the next
Yeah.
investment. So it's like kind of the exact opposite of the shale treadmill, as some like to call it. But I wouldn't be surprised if they can ramp things pretty quickly and get materially higher than this setup shows. But we'll have to wait and see on that. But I think as far as years go, I've seen people throwing around 50 to 70 years. And I mean, it seems ridiculous, even if you think management's full of it and take the under and say, I think it's 20. Like, this thing has plenty of time to produce a lot of oil and a lot of natural gas for, I think, at least, I think a decade is very, like, conservative. I wouldn't be surprised to see it producing for 20, 30, 40 years. But that's probably something that geologists could talk to better. But it's one of those things where it's not going to be a shale well where production peaks quickly, declines rapidly, and it's basically a trickle after like year 3. So
Okay. Now, do they have to sign long-term contracts? Given that it's an offshore project, they're not going to be selling this thing into spot prices, right? So, what can they sort of sell these? What can they sell this production for? And how are they going to organize those sales through long-term contracts with a major partner?
yeah, so I think basically what the setup is currently is they can't hedge it all as long as the until they refinance the Exxon debt. So at least for now, they're basically going to be getting. I think California gets Brent spot, from my understanding, and they actually get paid for natural gas because of some of the pipeline issues and transportation issues. Where I think there's a decent premium to like what you get in like the Gulf, but um, I would assume they're going to be using some sort of hedging program once things get up and running. We'll have to wait and see on the exact details of that, but at least for now, that's kind of wait and see after after they refinance the Exxon debt and kind of go from there.
Okay, so you're expecting they'll get somewhere in the ballpark of the Brent price quote.
Yeah, yeah. I think we'll have to wait and see, but I'm going to take the over on 70 Brent for 2025. I mean, everyone hates oil. You can't give it away right now, but I mean, everyone, even the commodities investors are fascinated with gold, silver, uranium, whatever strikes their fancy. But I think it'll be super interesting to see what happens with oil over the next couple of years because I don't think we're gonna be looking at $70, and I'd take the over on 80 or 90. I think so. Can't uh can't make too much. Can't predict the oil price too much with some of the manipulation and some of the things going on, but I think it's one of those things that has a setup where the stock is probably going to work even if we stay bumping around 70 or 80 on oil. So, I mean, they have plenty of headroom to pay that dollar per share per quarter that they're targeting by the end of 25. And if we do get some help from oil, then I think the capital returns could make that look like a drop in the bucket in say 2026, 2027. So
Yeah, indeed. Plenty of headways, production increases, price increases, debt refinance. Let's talk some numbers. So, assuming we can get to that 20,000 barrels a day production and we get somewhere close to the, let's just call it 70s to 80s Brent, what does the top line revenue for this company look like, and how much of that's going to flow to the bottom line? So I'm looking at analyst estimates, which would appear to be way off, and they're looking at maybe 600, 700 million on the top line. But if we get to those numbers that we mentioned, that would appear to be a little low in my book. How do you see the top line, the expense column, and then the ultimate free cash flow panning out over, say, 2 years' time?
yeah, that's where I've kind of put the all this stuff together and tried to figure out what I think it's worth. I don't know what it looks like as far as revenue because it really depends on what oil does, what their production ramp looks like, and all those things. I think that I've seen people throwing around like 500 million of EBITDA to 750. I mean, I think that's a reasonable ballpark as kind of 2025 moves along. Um, but as far as like their capex spend and all that, like there's a whole bunch of moving pieces, but I think it really depends on um their development from here. And I think that they're going to be investing pretty heavily in increasing production, and that might kind of restrict what flows to the bottom line for a bit. But I don't think it's going to stop them from paying out pretty decent capital return program. But as far as getting into specifics, it's like pretty hard to go in and say, okay, if we get to 20,000 or 30,000 and oils of the, I mean, there's a whole bunch of moving pieces, but the point is, I think if they ramp production, bring production online, do all these things, like it's not a $40 or $50 stock, I think. So the that's the long-winded way of saying I don't know, but I think it's like it'll look very, very cheap in like 3 or 6 months time buying shares today, in my opinion. So
Okay, so we're buying shares. We're looking out into the options market if we're that confident, or the bid-ask spread is just too wide.
yeah, no, I bought some of the 2027 leaps like the day before the equity raise, so that felt great. But I still think that like the right to buy something like this at $30 in early 2027, that'll look pretty attractive. So I have some of those. I have some of the April, I think 40s, but obviously not advice. Do your own research. You can get wiped out with options, all that stuff. But um, I think if you look at the catalysts I'm expecting over the next 6 months, say between first production and the refinance, and like it'll be a lot easier to understand, and the warrants should be sorted in the next 6 weeks. You kind of look at all that and pencil out, okay, there's going to be more investors starting to figure this out and more money flowing into the stock. And if you look at insiders and institutions, I think they own like approximately like 2/3 of the float. And there's I think probably a good chunk of people waiting to see first production, waiting to see what happens over the next 6 to 12 months. Some people will wait for first dividend, but I think like the biggest risk heading into kind of this year was like, hey, are they going to be able to settle with the county? And that's why it was basically a stub position for me before, where it's just like, all right, I'll keep 100 shares, keep an eye on it, see what happens. And then once they announced the settlement, I was like, okay, it's basically the green light. They're going to get everything they need, and more investors are going to figure it out. And I think it's a pretty interesting setup where like you don't see trophy assets in like a single asset company very often, right? So if you kind of go down the list of like, hey, $10 to $15 lifting costs, and I think they were projecting like 20 to 25 for the first year, just because as you ramp production, their costs are going to be a little bit higher, but those will come down over time. But if you look at the kind of the trophy assets, is like Guyana, some of the stuff in Brazil, some of the stuff in Saudi Arabia, like they're almost always going to be owned by a super major or a state-owned oil company or all the other kind of things where you're getting refineries, you're getting all this other stuff that is not just the trophy asset. So one of the things that's interesting with the whole California regulatory situation that I think some people might be reluctant to invest in an energy company there is, I mean, this is why you saw Chevron moving their headquarters out of the state recently, but they were trying to dictate to a lot of these companies, like, not only are we going to regulate how you run California operations, we're going to regulate how you're running international operations. And for a company the size of Chevron or Exxon, like, the reaction to that is basically no chance. Like, that snowball's
I
chance in
saw
hell of
that.
that happening.
That
So
was ridiculous.
it's
Even for
like,
California, that was ridiculous.
yeah. I mean, it's not surprising, but I think if you're confident that between like the pipeline regulations and the settlement and all the stuff that they're doing to make sure another spill doesn't happen, then I think you're looking at least 3 to 5 years of some pretty interesting returns, a very interesting setup, as the story I think will get simpler and simpler over the next year. And I think that brings in a lot of new money, a lot of new investors. So I'm very excited if you can tell. So
Yeah, I can tell. I only have a couple of questions left. You explained a lot about the potential risks. Have they announced the capital returns policy? Have they really put it in the presentation, or are people kind of expecting their past, from their past heyday, that they're going to continue with that capital returns policy? Is it going to be a fixed dividend? Is it going to be percentage of free cash flow? Um,
yeah, so I'm gonna pull up some notes here real quick. Basically, from some stuff I've seen from investor notes, from other people talking about it, and all that. Basically, the commentary is they want to get to $1 per share per quarter as soon as possible, and that, I mean, ballpark it back half of 25, probably later rather than earlier. Um, and that's before they get production up to 60,000 per day. And once they get kind of to that ballpark as far as production, then I think that's where they're going to be looking to buy back more stock or pay bigger dividends or whatever they decide to do. Um, if you do think it's a 50 to 60 year reserve life, then that's where I think the buybacks get super interesting. So we'll have to wait and see. But with insider ownership and some of the stuff, and a lot of very smart people kind of taking a look at it, I think there's reason to believe that they're aligned with the people that are just along for the ride, so to speak.
Yeah, that was my last question is, or my last kind of a paired question. This is a longer term hold given the production profile, and what sort of sizing are we positioning this thing in your view?
Um, well, I can recommend how I've sized it to other people because that's probably irresponsible, but um, I just don't think there's much that comes along like it. So I am put a very large portion of my money in it, but um, I think it's something where like and this has been mocking me for a little bit, but I've been trimming like stuff like Warrior Met Coal and Peabody and some of the stuff that's been ripping on news of China stimulus. So that's been mocking me for a bit, but um, I just don't think that there's stuff like this that comes along very often, and that's where I wanted to size it up. But the I think the the risk, at least right now, is basically in the rearview mirror, and it's still being priced like there's still something that is could go wrong and all that stuff. I just don't see that as very likely at all. So, I mean, we'll have to wait and see. But like I own a good chunk of it for myself, but I don't think I can't give position sizing advice other than I'm very bullish and very biased. So that's
Overweights in investment bank speak. We'll just put it as overweights, and we'll go
yeah,
from there.
that's
I like
probably an
it.
understatement. So
Yeah, well, there we go. It'll be interested to see how it all unfolds. Let's talk about something that I still have PTSD. It's Greek shipping. I have all the scars in the world. Greek shipping. I swore I wouldn't even mention it again on my channel. But here we are. We're talking about a Greek shipping company, and we're going to use those famous words. This time is different. Let's talk about Navios Maritime Partners. How are the Greeks going to swindle me this time, Benny? How are they going to do it?
well, I think that's where this time is different, but we'll have to wait and see how it plays out. But I think with this one in particular, with the insider ownership, I think CEO is up to what 17%. There's a couple other insiders or large investors that own. Between the CEO and those couple investors, I think it's like up to 55, somewhere in there. Um, and I think that's where like you started to see the buyback turn on. Like it's not super liquid, so they haven't been buying back a huge chunk, even though they could be in theory buying back more. But I think with the gap to NAV right now, where like right now, the couple of people have it pegged. Like I saw one at 158, I saw one at 142. Seen a couple people say 150. It's like today's NAV is say 150. Like there's enough average around there
Well,
to kind of
NAV is
make that
a
mate.
moving target. What do you think? What do you think replacement costs might be for the fleet? And then let's get your accountant on and give it a bit of a depreciation, and let's go from
Yeah,
there.
that's where like you said, NAV is a moving target, and with some of the stuff that I think is going to happen with ship values and day rates, I've seen several people kind of predicting NAV over like $200 by the end of 25, which makes some of the leaps very interesting. But as far as like their fleet and their kind of asset value, like it's something where like with the new builds they have coming and some of that stuff, I think it's just the setup that doesn't come along very often. And I've basically completely avoided shipping because I know that like certain sectors go in and out of favor. And so I'm not like someone who's been deep in the weeds or has like 10 years of experience trying to avoid the booms and busts, but they do have basically a pretty even split between containers and dry bulk and was it tankers? So you're also kind of not completely exposed to one sector. which I think is nice. Some people prefer the pure plays, but that's
So
for
tankers
someone.
and dry bulk I really like. Containers have a pretty big wave of new builds coming online. So you're discounting it and say it's so cheap it doesn't really matter anyway, or you think there's enough upside in the dry bulk and the tanker aspect to make up for the
Well,
dynamics of the container side.
the the thing that's interesting about, I think they basically have contracted the containers and the tankers and left like most of the dry bulk open, from my understanding. And so
Good
like
move.
they're
Maybe
pretty
that's
much
something I might
locked in
try.
there. And as far as like exposure to containers, I know people talk about Zim and you see that flying all over the place when people get bullish on what's going on in the Middle East or whatever's going on. But um, as far as their kind of exposure to dry bulk and the tankers, like I'm definitely kind of more bullish on that side than the containers. But the biggest thing I think is the discount to NAV and the growing NAV and growing capital returns. Like when I first started looking at it, I was like, okay, this looks interesting. And I basically was looking at the incentive distribution rights where if they get the dividend payout to a certain level, then the manager, aka the CEO, will be able to start taking a portion of that. I think it's basically that kicks in at like $24 a share. And then it I think the incentive gets even juicier as they ramp up from there. So that's a long way of saying like if they start paying out 24 bucks a share, that's pretty interesting on the current stock price, but that's probably at least 3 to 5 years out, I would guess.
Okay, so
Um,
unpack that for me. Explain it to me. So this is the rights to increase the percentage of payout of earnings. How does that work?
yeah, so basically, like once they hit, I think it's like 24 or like 24 and 15 cents per year in dividends, then like a portion of the dividend payout will start going to like the management group, which is, I mean, that's how you see managements taking their salaries, and like you end up with these Greek shipping companies that look cheap, but then it looks cheap for a reason, right? But um, it really ramps where like if in theory they start paying, I think it was like $100 a year in dividends, then I think
Which is
only
what stock
60.
price, yeah, stock price is $62. So even
Yeah,
24 is,
you,
let's
you
just
you
call it
need
a
a
third.
big time shipping cycle for that to get. But I mean, that's what they put out on the chart.
Okay.
And if you do get to $100 in theory, I think like that payout would mean I think 66 of that goes to like common shareholders. So everyone but the CEO. So like a big portion of that chunk starts going to the management group. And so there's kind of a different piece of the pie as that dividend ramps up. But um, I wouldn't be surprised to see them stick with the current 5 cent payout. The basically here's your chump change,
Yeah.
but at least for now, and kind of continue with buybacks. Um, and
Okay.
then when they decide, okay, now's the time, then that's when the dividends start to kick in. So, but that's longer. I would say 27, 28 is when you could start seeing kind of dividend really start to bump, but
But
we'll have
currently
to
we're
wait and
looking
see.
last 2 years they filed 16 and a half, $18 of free cash per share from what I'm looking at, which is, I mean, really, really cheap given where it's currently trading. What do you think this thing can do ultimately in a few years of decent shipping environment? It doesn't have to be blockbuster.
I mean, if you tell me we're going back to a dry bulk cycle like we saw 2008, and that's the other thing I think is interesting is you're going to see a lot of the fleet start to age out and hit that 20-year age limit. I think in 28, 29, and that's where their fleet looks really interesting because they are pretty well positioned for that. Um, but as far as like if you tell me what dry bulk is doing like 3 to 4 years out, then I could give you a guess. But I mean, the numbers get like basically they just get insane once you really get into like a dry bulk bull cycle. And if China's going to be pumping the liquidity bazooka, then that bodes well for iron ore and coal and all the other stuff that kind of fits into that dry bulk sector. So, um, I mean, I wouldn't be surprised to see like over a billion a year, and that could be a low ball depending on what we see for dry bulk and the other sectors. So
Okay, are you
basically,
talking free cash, net income, EBITDA?
um, I would guess, hmm, I would say, well, what are they doing right now? Let me pull this up.
Yeah.
So if they're doing,
So billion's roughly their top line, a little bit less than their top line for the last 3 consecutive years, which have been kind of mixed and not too bad for the shippers.
yeah, let's see. I would say, I mean, I wouldn't be surprised to see this thing earning like a billion a year. Like if we truly get a like bull cycle for some of these sectors, which I think is coming. But as far as like one of the things about what I try and do as far as investing style, I basically got out of the public accounting, the Excel spreadsheet rat race, but with kind of some of the stuff I find interesting is like I think it's so cheap that it's more important to be like directionally right than get down into like the nitty gritty of okay, if X happens, then Y is like company results and all that. And I think when you gotta look at where some of these cycles are going for shipping and for energy and some of these other sectors, I mean, I think it's more a case of buy right and hold on. And so that's kind of where I'm at for some of this stuff.
It's
Um,
true. In shipping's a little bit more of a shorter timeline in your investment horizon. So we want to have a rough ballpark as to when we're going to sell. Otherwise, we're going to be end up holding a big bag of Greek doo-doo.
That's where if you go back and look at the max chart, it's not pretty after 2014. So I totally understand. I would say I think it depends on that. That's where you pay attention to kind of big picture stuff, like what does the order book look like? What does the shipyard capacity look like? Which by the way, I've seen a couple people hit on this. The was it shipbuilding capacity is down like 60% internationally over the last decade. So that's going to be a big bottleneck and definitely going to be a bottleneck for some of the offshore oil services as well. But um, like I think that this shipping cycle could easily last like 3, 5 years, and it's obviously something you kind of reevaluate along the way. I'm not saying this is a buy and hold forever because it's not. It's a cyclical industry, but I mean, I could see some of the stuff taking till 2030 to play out just because of how long it takes to build ships, what it costs, what you need on day rates and contracts and all that stuff. So, um, like this is obviously not a like buy it, go to sleep for 5 years type company, but I think that it's definitely possible that we're looking at like 2028 and things are still kind of heading in the right direction for the cycle. So,
Yes, there's a lot of obstacles that would need to be removed miraculously quickly for us to clear up that shipping new build capacity. You mentioned offshore. Last we spoke, or since we spoke last, day rates seem to be going in the right direction that we were expecting. If I have to get your quick take on offshore, particularly with regards to bore, which I know we both like, Valaris versus rig, which is always the classic duel, and then sea drill enters the chat. How do you see things playing out in the offshore space?
yeah, so I think if I were just buying the common shares today, I think Bohr is probably the most interesting. The and this is I was like I've been basically trimming back all of offshore oil services to buy Sable, so that's been painful over the last couple months. But the thing with Bohr, I think is super interesting, is basically between now and the start of I mean call it Q1 of 25, you're gonna have the new builds get delivered. I would assume they start buybacks at that point. Like I can understand wanting to keep some cash on hand and have all that kind of on the side to deal with whatever it takes to get these things delivered and in operation. Um, I'd be kind of surprised if they raise the dividend payout at this point, but I mean, we'll have to wait and see on that. But I think it's what, like a 7% yield somewhere in that ballpark now.
Yeah, I mean,
Um,
there's, I don't know why people you wouldn't be complaining. I mean, you're getting paid. My uncle Rick would say you're getting paid to wait, and I think you got a five bagger in 5, 6 years. But anyway, that's neither
I
here nor
think
there.
that if you get some love from the oil price, which I think is coming, I think that's, I mean, I could see more than that. We'll have to wait and see, obviously, but I think what you're going to see is once the new builds show up, then the capital returns in 25 and 26 make this year look like a drop in the bucket. I'd be partial to buybacks, obviously. When you have, was it trading at 30 to 35% of replacement cost, somewhere in that ballpark, it's just like that math works really well. And if if we do get day rates continuing to grind higher for premium jackups, like that one, I think is basically a layup if you can hold on to it long enough. On to kind of deep water guys. The thing with Transocean that I like is their fleet and their management. The thing that uh, basically just forced kind of the sell decision, at least for me, was some of the dilution. And if you look at like the share count outstanding, excuse me, if you look at the share count outstanding, it's basically every quarter you get a continuous dilution. So I still think it's worth a lot more than the current share price. But they're going the opposite direction of shareholder returns, which is always painful. And with their contract book kind of locked in, it'll be a while before some of that like 650,000 day rate and some of that stuff really starts to show up. But I think we're like we talked about shipping and Navios being cyclical. I think that like this deep water cycle has a good chance of lasting like into the mid 2030s, I would guess. Just because I mean, you look at like we said, the shipyards and all this other stuff, like this thing is gonna take a lot longer to play out than I think people realize.
Shale growth is anemic
And
and rolling over, so you got to get this liquid hydrocarbon somewhere.
yeah, I think between that and shipbuilding capacity and what it's going to cost, say 5 years out to like even order one of these things, like it's not going to cost $1 billion. And I'd honestly be tempted to take the over on 1.5 billion, but I mean, we have to see what inflation does. Um, and if you start running that math, then what you need for day rates like really starts to get interesting. And then you can buy some of these fleets at 20, 25, 30% replacement cost. And then it's like, can you hold on long enough and stomach whatever is going on with oil lately?
That's the
Um,
question. The question is always around, well, with Transocean at least, the liquidity profile and whether their fleet is real, whether they're really going to be able to monetize the fleet the way they say they can. A lot of people criticize their recent sale, but those rigs weren't particularly useful. They weren't a key part of the thesis, and they were chewing up around 80 mil a year to keep these things going. So I say sell these things, focus on the balance sheet a little bit so that you can get to the environment where your Atlas and your Titan and your Hoop, what have you, you're getting that 635, 650 day rate comfortably averaged out across the fleet. Do you have any concerns about the liquidity profile?
um, I mean, not really I don't like the people that say rigs going bankrupt. Like, I don't understand what they're looking at, honestly, but I don't think this is, I don't think it's a donut. So if it would have happened, it would have happened in 2020 or somewhere in there.
One would
As
assume.
far as, as far as the, like setup, like I don't have a problem with asset sales or anything like that. Like I kind of wish they would have waited to contract a bit. Like locking in contracts right now for any of these guys, I think if I think an oil run is pretty imminent, and I think locking in like some of the 8G drill ships at like 650 in like 2028, I think that might look premature.
It's a bit of a
Um,
Polaris move, really, isn't it, in some ways?
yeah.
Um,
Um, but yeah, to move over to Valaris, like a good chunk of their entire contract book, I think rolls in 25,
Mid
and
25 is the
it's basically was it like seven? It's either like 7 or 8. It could be 9, but whole bunch of drill ships between like today and the end of 25 will be on new contracts, and that makes the math pretty interesting on that one. I'll be looking to buy some of those warrants back at some point, but have to wait and see there. As
yeah.
far as it, oh, go ahead.
No, I was only had a short question around the warrants. I already own an irresponsible amount of the stock, but these warrants have come down since the recent price decline. Explain to me the expiry, the strike on these warrants, and why they used to be, I believe, one of your highest conviction plays.
Yeah, so that's where opportunity cost comes knocking, and I wanted to buy Sable more, and I wanted to hang on to these. But basically, with the Valaris warrants, like I still think you're looking at a huge, like it's a huge asymmetric trade. And so the terms, if I remember right, it's right to buy at was it 131. It's between 131 and 132. I think it's like 88 cents or something. But call it 131 and 88 cents is the exercise price. And that the expiration date is like end of April of 2028. So you have a lot of time to have this play out. And if you think we're getting an oil bull market and you think Polaris's contract book rolls, you think they're like distressed debt investors on kind of coming out of bankruptcy, if you think they sell their shares and kind of clean up the who owns the shares, then I wouldn't be surprised to see like $200 to potentially higher, depending on what oil does by that exercise date. So
I think
that's
everything you said will play out. By when is the question. If we have a little bit of a hiccup in the global economic environment, which traditionally does happen once the Fed starts to cut rates, although everyone gets a little bit of a sugar high, it if you follow the 18 months post, it generally doesn't look so rosy. Can the oil market recover, even though we're talking offshore, we're talking, contracted? The general market doesn't understand that. They just see, oh, oil down, anything to do with oil must be down as well. That's what might concern me, given the fact that you got an expiration date by 28.
yeah, I think that's where your views on the Permian have to play a part. Like if you think the Permian's still growing by 2028, then I mean that's where you might want to stick with the common because I think that's pretty I mean it's still ridiculously cheap anyway. If you think the Permian's going to roll over before that, or if you think Israel or Ukraine or whatever kicks off some geopolitical shit show, then that's where the warrants I think get pretty interesting because if you if you get some love from the oil price and like you said, it's oil red, so everything oil related just gets whacked. And I mean, it really doesn't have much to do with the business because they're contracted and whatnot, but that's how the stock market trades. But the I would say it kind of depends on what your view on kind of big picture macro is for Permian Basin, for what's going on with production. I mean, if you look at the oil chart, I think Exxon put out of like what happens at like the current investment rate in hydrocarbon production and like the gap between today and 2030. Like at some point, like the physical market wakes up and the paper market trading, all that stuff, like that can't keep a cap on it forever. So I think the chances were below the exercise price by 2028 is extremely low. But we'll
So
have
what
to wait
sort
and see.
okay. So what sort of return is on offer for these sort of things? So even if I were to say put a 25 basis point stub or flyer, and the stock price does what you think it might do within the allocated time frame, and what are the warrants trading at today? I haven't looked, so sorry to put you on the spot.
$8.40. So
So
if
we
you
got to
think
get
we're
to 139, $140, let's say, for this thing to be
yeah,
break even.
basically right to buy at $132, just round up. And if you think we're going to 200 by 2028, which I would take the over on that to be honest, then you're looking at warrants being at what 65 plus. So if you're taking the over right, if you're buying shares right now, that's what a little bit under 4x. If you're buying the warrants, that the math gets pretty interesting as you start going over $200. So
Yeah.
um, potential for pretty explosive upside if you're right. Obviously, like the time does add some complication to it, but I think anything like I wouldn't be surprised to see the warrants trading for like I could see $100, honestly, right? If you're looking at 230, 235, somewhere in there. And it seems
You are
seems
the
ridiculous
least
now, but
conservative accountant I've ever met in my life. I
Yeah,
need you
if
doing
you
my cash flow projections when I go and finance my next roll up.
well, if you saw my portfolio weights, you'll understand that that is definitely the case. But I mean, it's just one of those things where if you think we're actually kind of on the cusp of like a true commodities bull cycle, which I think is coming, and gold to oil is basically at all
Gold's telling us
time.
we're here, mates. We're here. The lid is off. The lid is off, as we
Well,
say in Australia.
that's the thing is like the gold to oil ratio is at like 40-year lows if you take out negative prices in 2020. And like if you think we're getting to gold going to 3,000, 3,500, 4,000, which I mean, I would say like 3,000 by the end of 25
300.
is
Oh, yeah.
is pretty easy, and gold at 4,000 by the end of I don't know, 26, 27. Like if you still think we're at like $70 oil with gold doing that, like something's broken. So the that's where I think it's kind of interesting where there's a lot of value in certain spaces in energy, and that's what I find pretty interesting to be looking at. But I think I think oil is going to start to wake up in 25. So we'll have to see if some of the paper market shenanigans or some of the news headlines like the one out of FT last week where it's oh, OPEC's thinking about bringing back production. It's like really just for the sixth time in the last month or whatever it's been. Like those articles are a dime a dozen, but the algos trade them, so it
Exactly.
is what it is.
Yeah.
So
And like the IEA demand estimates that get upwardly revised every year. But anyway, that's another story. And now another interesting thing. I first looked at Warrior Met Call and I said, I'll have to wait. And it's I just put it in the too hard basket. And this is like a 2 second overview. I already had other positions which have done very nicely. But Warrior Met Call, you're very, very confident that we can get to, say, a triple digit stock price, given we've got a new mine coming online when 25, maybe 26 at the latest.
it's mid 26 is kind of when they're targeting for Blue Creek.
Okay. So with Blue Creek online, I then went and said, hang on a minute. What sort of new production could this thing get to? And what would that mean for the bottom line? Now, I wrote out on the back of an envelope basically that thing might get us to a 800 million kind of EBITDA addition, and no analyst seems to be pricing that type of scenario in. Talk to me about Warrior Met Coal and where we're at. Why is this thing sold off, man? And everyone's panicking, and Blue Creek is still on track to deliver well, what's that going to be worth? By the end of that, it's going to have what, 12 million tons production across the entire company, something like this.
Well, I think if I remember right, the production increase once Blue Creek online is like 40% or something for the company. Like it's
Yeah, yeah,
pretty material increase in production. And I've seen people if you guys don't already follow the Coal Trader, you guys definitely should. They I think they were kind of talking about 800 to a million in free cash, or a billion, excuse me, 800 to $1 billion in free cash depending on coal prices and whatnot. But um once that mine's up and running, and then it turns into, is it buybacks or dividends, right? Because right now we're trading at 3.4 billion market cap, and the balance sheet is very clean. There's very little debt. I think they're what, 700 million in cash, somewhere in there. Let's see.
yeah, about 550. Excuse me. If you're
Yeah,
looking at net debt, net
710
debt.
in cash and then 150 in debt. So, 550 in net, give or take. But it's just one of those things where when this thing starts spitting out cash, it's like, I'm not saying it's AMR 2.0 because you're not going to go from 3 to 400 in like the completely bombed out cycle. But I mean, it's the type of thing where I think triple digits is like, that's where the market starts to price in Blue Creek coming online. And then people will look at it and say, well, was this thing going to pay out in dividends, or was this thing going to do in buybacks? Because after that, like with it being like the low cost producer has higher quality than something like AMR as far as their coal, and all the stuff that I think is pretty interesting. I do have some questions about the Australian like royalty regime in some of those places, but with Warrior being in Alabama, then I think that's kind of a non-issue. So like Peabody has some questions there. I know like I'm still bullish on some of the coal names, especially with recent events, because Australia and China, like that's pretty tightly linked. But I do wonder if that government comes knocking at some point when they see those companies making a whole bunch of money again. So
Yeah, the Queensland government for sure will. Um, but I think that everything you mentioned about this, the geographic situation of Warrior Met Coal, that originally, and it was more of a concentrated, smaller number of mines, kind of made me a bit hesitant. And I thought, oh, well, if you have one bad event happen at one of the mines, that significantly impacts production. But I'm now taking the other view of saying, okay, but it's in a much safer jurisdiction. You really don't, you got economies of scale, all that sort of thing, lower cost producer. It's probably an easier one to understand. Um,
well, I
so
think too they have was it like 20 there was it number 4 and number 7 are both like over 20 years reserve life, and once Blue Creek comes online, I think they're like talking like 50 plus. So it's
yeah,
like super long lived assets, and basically like you can buy that before the inflection comes in, call it like 2 years, give or take, and like that's just a cash flow explosion, and then they have to either figure out who they want to go acquire and blow that money on the acquisition, or if they're just going to do dividends and buybacks. So
dividends and buybacks, dividends and buybacks. You've got that long
yeah,
reserve life, don't you dare.
yeah,
So we're coming up on the hour, mate. Good chat. Anything else you wanted to cover? We briefly mentioned metals, and that seems to be taking everyone's attention as we speak. You wrote a little piece that I enjoyed about South African miners, Impala versus Sibanye. And perhaps you might like to leave us with a bit of commentary around the metals market or anything else that takes your fancy.
yeah. No, I think platinum is one of the most interesting setups where I think there's some parallels to uranium several years ago, where like you can see the gap between supply and demand and all these different things, and it's not rocket science to kind of pencil out like, okay, where are we in 3 to 5 years? And like the answer to that is a lot higher on platinum prices. And if you want to add rocket fuel, then you go buy the South African PGM miners like Sibanye or Impala. I know Angleplatz also, or Amplatz also has the like shareholder like demerger or whatever they called it with their parent company. So that's maybe gonna create some more selling, but potential opportunity there. Um, but as far as Sibanye versus Impala, I kind of looked at Sibanye. I basically took a lotto ticket size position in both of them, and then when
Come on, mate. You can do better than
when
that.
say, huh?
You can do better than that. Come on.
No, I know
In a
it.
degen, come to the fore.
If some of these other things play out over the next several months, I'll be adding to Impala and probably buying some more physical platinum. But um, with Sibanye, I was looking at it's like, okay, what's the plan for like the lithium and the other operations? Like it's like Frankenstein's monster of a whole bunch of assets, whereas Impala is like, okay, much better balance sheet. It's still bombed out cheap, and if you think platinum is say just going to 3,000, say as a round number in the next 5 years, then platinum share or Impala shareholders are going to do very well. Same with Sibanye, and you probably get more out of Sibanye, honestly, because of the torque with the balance sheet. But um, as far as the like headaches you would have to go through owning Sibanye, I kind of view Impala as a better risk reward because like if you get that kind of like move in platinum, then like these are big companies, but the stock is gonna like at least 5 times, right? If you're getting a triple on platinum, then it's not out of the question to get that kind of move in the miners, assuming we don't get another kind of South African like country meltdown, which is kind of baked into the share price and obviously a possibility with their operations down there. But um,
Is, but I mean, recent elections probably were more positive than many people expected, and I think the way I view, I wasn't underwriting 3K platinum, but I was looking at where Sibanye's all-in sustaining cost sits roughly. They've done their forward sale deal with the gold. They're going to be breaking even until we get to the point where basically it's a big call option on platinum being above roughly call it 1250 or 1300K for their all-in sustaining cost. And They shut down the high cost mine, which they control. Global, that's like 3% of the global supply, something like this. And
That's the only, I think, PGM mine in all of the US, I think, that was operating.
I
That
think
was
that's
the
worth. I think that's
Stillwater.
worth a
Yeah.
lot. Being able to control that bad boy, and then be able to realize the rest of your production from South Africa.
Yeah. No, I think the reason I was throwing out 3,000 is just because like I'm obviously like big commodities bull, and I think gold's going higher, silver's going higher, and people are going to eventually look at plate or platinum and the PGMs and say like I think the
historic ratios.
pylon is basically the like the Hoover Dam through a garden hose type analogy that I've seen people use before, where it's like once platinum really starts to move, like it's not like we're going to move to 1,500 or 2,000 and it just stops. Like that's not how precious metals work, and not how I think platinum's going to go. Um, but I mean, it does seem a little bit, uh, I guess maybe overconfident is the wrong word, but like I
No,
think
I think you've got a
platinum's going to
strong.
have.
I think you've got a strong logic. In addition to which, we've got the. I won't say the failure as such with the EVs, but we're perhaps rethinking our stance on the timeline of EVs taking over the world. So that means a
Well,
lot of
the
extension
timeline is
required in
the timeline
commodity.
on EVs is never going to happen. So that's my timeline there. It is. I think we kind of hit like peak ESG madness like a couple of years ago,
Yeah, it was
and
2021. I want to say somewhere around there,
yeah,
22.
right when interest rates started going up.
Yeah,
That's
what do you know?
an
Yeah,
interesting coincidence, right?
yeah.
Um, the but like solar, wind, like all these different things, like they just don't work in like a current environment, and that's where I think when the narratives start to shift and people wake up to like PGMs, for example, then people are going to be like there's a reason like the platinum card tier on credit cards is above like gold tier, right? And like if you look at like I was talking about gold to oil, if you look at gold to platinum right now, it's even more interesting. And
Yeah.
like I'm not saying it's going to be a monetary metal, but it is what like 30 times scarcer than gold. So like that's I mean, I think that's the one to be in if you're looking for a torque.
Absolutely.
And I mean, we'll see what happens, but I think there's a potential that when the precious metals kind of go into the meme like bubbly type sentiment phase, that platinum does something ridiculous to catch up. So that's kind of, I mean, that's the thing is if you're like you're not buying the platinum miners in South Africa because you're expecting platinum to be around like $1,200 and all these things are cheap no matter what. And like, no, you're expecting like a big bull market in platinum, and the miners are gonna be just. I mean, I've seen people that have basically projected like, if we get what was it? It was maybe like 2,000 or 2,500. Like these PGM miners like make their entire current market cap in like 1 year, right? And that math
That's
is
what we're here
like,
for.
yeah, that's where the torque comes in. It's like, okay, if they're doing that and paying dividends, like the stock's not at $4 or $5 or like probably at 15, 20, probably more, honestly. But
It's 25,
that
30 at this point, yeah, I think.
yeah.
And there's still more upside, but I'll be heading for the exits at that point in time. Well, this has been a fascinating discussion. I appreciate it. Guys, Ben's Substack, Contrarian Corner, all the links, etc., will be in the description. Make sure you head over there to learn from the wealth of knowledge that's available on the Substack. Thank you very much for listening to the ROI podcast. Take care, guys. We'll see you in another episode shortly.